Jermaine Sullivan.
Here.
Wesley Smith.
Here.
Doug Parks. Ed Bradford.
Here.
And Jeff Rowe is out today.
You have another attendee, Kelly.
And Bill Gamble.
Here.
Somebody else is trying to join the meeting.
I see what you're saying. Perfect.
Okay, old business, Hound Resources royalties.
So you can see the report on the back of the second page. They've been sending those in. They've gone up slightly with the price of oil, so that's good. I think we're in a good spot with them. I've helped 2 or 3 people in town that have had trouble getting their checks, so I've connected them with Hound, and they've kind of worked through it and are getting that stuff corrected. The problem that they're having, one, was the records were kind of bad from Aztec apparently, but 2, there's so many just minute royalty holders in the city that they don't pay the checks out unless they have a certain amount, because otherwise they'd be sending them, checks for 37 cents or something. And then there's a lot of people that have passed away and stuff, so they're trying to clean that up as best they can. And I've been kind of firm with them that they need to make it better effort at that, but I've helped 3 or 4 people, like I said, so I think that's coming along.
Okay. We good on that one then? Okay. Approval of minutes from January 26, 2024.
So moved.
Support.
All in favor?
Aye.
Aye.
Okay, motion passed.
Investment advisor update and commentary.
We're ready for you, Woody.
Great, okay. I think, does everybody have the materials in front of them?
Yes.
Okay, because we could screen share, but if you have copies, we'll just kind of work with our faces on the screen instead of, well, what's better for you guys?
Hang on just a second, Woody. We're gonna see if we can get a better mic going here.
Okay.
Say something now, Woody.
Okay, so if everybody has a copy of the presentation, maybe we'll just, pardon me, proceed as is. How does that sound? Excuse me. Ed, can you hear us?
Yeah, much
Yes.
better. We should tweak something on our end.
Okay. You want me to keep talking?
Yep, go ahead.
Are you testing the mic, or do you want us to start?
You're ready to go. So we're good for Woody.
Okay, good. Okay, well, what we'll do is we'll just dive into the presentation, and we'll go to page 4, which is titled Bartlett's Market Assessment, and I'll hit a few high points, and then I'll turn it over to Brian. You all know Brian. Brian's been on a number of these calls, and Brian and I work together with Troy in managing the oil and gas portfolio. And on page 4, we have some of the high points, and I think it's fair to say that the economy continues to be pretty perky, exceeding expectations, which, is kind of surprising financial markets. I think most people thought the economy was going to slow down, and then the Federal Reserve would lower interest rates to pick things back up a bit. Well, the economy continues to be pretty strong. Unemployment is very low. Economic growth is good. Inflation is decent, but we'll expand on the inflation topic in a few moments in terms of kind of taking that apart and looking at more of the elements of that. But overall, surprisingly good news from the economy, and the financial markets have responded accordingly. We had a good first quarter. And with that, I'll turn it over to Brian, who might want to expand on some of the charts. Brian, you're on mute. I think also before I think the inflation piece, I think we have, let's see, is that, I don't know if that's in the booklet, Brian, is that piece we put together? I don't see that in the booklet. Anyway, that's an internal thing. But anyway.
Okay. Yeah. Well, let's see. So as Woody mentioned, the economy remains strong. The labor market remains robust. Sticking on page 4, the area of caution, the first point there, the inflation story has really been one of the key drivers of the market over the last 2 years, and it remains so this year, and especially so more recently. Last week we had a fairly high inflation reading come back in, and that's actually kind of 4 months in a row where the inflation was above the expected level. So we're struggling, even though inflation is much improved from where it was 2 years ago. We're struggling to kind of land the plane and get inflation back down to where the Fed wants it, which is right around 2%. So I hope you have the charts. Maybe we'll start with page 5, and where you can see improvement in inflation has been moderating. The bottom line shows the year-over-year CPI, so that's measuring inflation broadly in the U.S. And you can see in the summer of 2022, inflation peaked at over 9%. And that was right around the time period where the Fed started very aggressively raising rates. We went from short-term interest rates of 0% to 5.5% today. And that was all in a very short time period of about 14 months that we raised rates that quickly. Well, and that is the Fed's main tool for fighting an inflation, and it was very effective, bringing inflation down from 9% down to around 3%. But like I said, we're having trouble getting inflation down to the last level. It's kind of sticky in this range of 3.5%, where it was last month. Hopefully you can see, do you see a table in front of you? Housing continues to drive high inflation?
Yes.
If not, I can share my screen.
No, we've got it.
Okay, good. So just wanted to give a little bit more color on, what's driving this, because it does have a big impact on the markets. Until inflation is more under control, we're unlikely to get many rate cuts or significant rate cuts from the Fed, which would help equities. So I'll point out a couple of things. The headline CPI, as I just mentioned, was 3.5% in this last monthly reading. That's year-over-year inflation. So one thing that can be confused is the headline number includes these categories that tend to be a little bit more volatile, food and energy. And you can see those have actually been pretty well under control. Food inflation is down to about 2%, 2.2 year-over-year. And energy is, gasoline prices have picked up here recently, but energy year-over-year, at least when this was measured, was down to 2.1%. Those headline numbers are food and energy, as I mentioned, tend to be very volatile. And what the Fed really looks at is core inflation. So core inflation below is actually running a little hotter at 3.8%. And this actually makes up a much larger percentage of the basket that they're measuring. These core items make up about 80% of the basket. And so this is really what they focus on. They know that food and energy are going to be volatile, but if the core prices are kind of more stable, that gives them a better gauge for what inflation is in the system. And that continues to run hot. So there's a lot of underlying categories here, but we just highlighted what we thought were some key ones that are really driving why inflation is still sticky. So core is kind of broken down into goods and services, and goods have actually been deflationary for the last year. Prices are down almost 0.75%. It's really services that are driving a lot of the price inflation. And that's the exact opposite of during the period of COVID. It was all goods prices where we're all sitting at home and buying too many things online that was driving up goods prices, but now it's flipping at services. And, a very, very key piece of this, no surprise, if you think about, what you spend on a monthly basis or annual basis, shelter makes up a huge percentage of that services bucket and of the overall bucket of CPI. It makes up over a third of the CPI measure. Well, housing is still running at over 5.5% year over year. And that's that's been really the sticky piece that the Fed rate cuts have not been able to help improve with inflation. You would think higher interest rates drive higher mortgage prices, should help with housing prices, but we're just not seeing quite enough supply on the market yet to really help with the housing prices. And the one other kind of surprising measures that we pointed out, and it's a much smaller part, only about 3% of the CPI, is motor vehicle insurance is up over 22% over the last year. So that, in combination with the shelter, is driving over half of the inflation in the system right now.
Brian?
Maybe I'll take a moment. In our experience, there's always a major force that is influencing market direction. And over the years, we've seen this. Sometimes it's geopolitical tensions in certain parts of the world. Other times it might be the trade deficit, money supply. There's things that the market obsesses over. And today, probably the primary factor that influences market direction would be what the monthly inflation number is. So the monthly inflation number is a result of what's going on with the economy. It has this very direct effect on interest rates. And so everything kind of goes back to that source. And so I think understanding inflation, like Brian just explained it, kind of helps understand what's going on with the markets, because over the last 18 months or so, the reason we've had a very good market is that inflation has been trending down with a good economy. And if it starts to trend back up, we probably have a problem. But if it starts to kind of slowly subside again, that's going to be good news. And so anyway, that's kind of the linkage between inflation and the kind of the portfolio of the oil and gas fund. Any questions on that topic?
Why is car insurance up 22%? Have they just lagged with the price of cars going through the roof, and they're trying to play catch up?
Yeah, that's a great question, and you're right. Typically, auto insurance rates lag car prices by 12 to 15 months. And as you see on that page, new vehicles and used car prices are actually down, but we can all remember when those were up 25, 30% a year or so ago, as recently as that. And so some of it's that, some of it's weather related. And we've had a lot of significant weather events. Unsafe driving has actually up and has contributed to some of that. So it's a number of factors, but most of it's due to the increase in prices a year ago.
Brian or Woody, just a quick question. Back on page 4. The Fed chairman gave a quick speech on Tuesday afternoon. How'd the markets react to that? Did you see bond rates changing, or the stock market really go anywhere? I haven't followed it, but I know he had said we're not going to make a June adjustment.
Ed, could you repeat that?
Oh, sorry. I wondered with the Fed's chairman's comment on Tuesday, what effect that had on the market, either bond or stocks, with him saying he's not going to look at a June adjustment or not considering one.
You can repeat it.
Brian, you're breaking up. couldn't hear the question. Did you hear it,
Forget
Brian?
Woody, can you hear me okay? See if they can hear your mic.
Barely.
Can you hear?
Forget it.
Can you hear me?
I can hear you.
No, just move on.
No, that's okay, we'll ask
Later.
her.
I'll just ask it, because I think it's a good question. So Woody, the question was, the Fed chairman gave a speech a couple days ago, and did you see any effect on the markets, particularly the bond market?
Well, I think the speech you're referring to was his minimizing expectations for a rate cut, that they'll wait and see how inflation develops. But I think there was a lot of expectation that rates were just going to go down over the next several months, 2 or 3 times through the Federal Reserve. And he basically said, well, we're just going to have to wait and see. He didn't make any promises. And I think the market responded kind of like what you'd expect, because they were hoping for lower interest rates, and that's a little bit like a cat for stock market for the stock market. So I think it was a bit of a, the markets responded. I think interest rates went up a little bit, stock market went down. It was, I think that's what you're referring to, Doug.
Yeah.
I don't know if I have any more color. Brian, did you have any thoughts on that?
Well, I think page 8 in the book helps illustrate the impact of the speech last week. But the market's been anticipating that rate cuts are more and more unlikely since the beginning of the year. So the blue line shows where bond yields were at the end of 2023, and the line above that shows where yields are now. So yields have moved up significantly since the beginning of the year, and that's all as a result of the market pricing and less likelihood of rate cuts this year and higher inflation expectations. That 10-year number kind of reflects the higher inflation expectations.
On page 8, is the one in the booklet or on the tablet? Because the booklet, I think, is a different page.
The chart that's titled "Interest Rates Have Increased in 2024."
That's actually page 9 at the bottom, but.
Okay.
That's actually our page 8.
Oh, okay. I think I must be looking at I must have sent a different booklet. I'm looking at a booklet that was prepared, and it's not the same one I sent to Kelly. Sorry about that.
Okay. Thank you.
Well, let's, Brian, did you want to hit on any of these other charts?
No, I think those are kind of the salient points, and we can switch to the portfolio.
Hey, Brian, I have a question. Can you hear me if I speak really loud? Because our mic system.
I can hear you.
Problem. Okay. So you talked about housing and what we're experiencing here in Manistee, which isn't any different than I think some places, is with mortgage rates going higher and a lower inventory, and the way property taxes are capped in Michigan, you've got people that aren't willing to leave their houses. And so not only are people not building new, you're not having any inventory for existing houses because, one, they drive their taxes sky high because that property would uncap when they moved into a new one. And they simply just can't afford that. So plus they couldn't find some place to move anyway. And I don't see how that cycle gets broken short of some kind of a recession. Do you guys have any, I mean, I'm sure that's similar in other locales other than just Michigan.
Yeah, it's, I think similar across most of the country, certainly is in our local market as well. I think we are seeing a pretty big explosion in multifamily housing construction. So that less people or more people will be going towards renting. Just that calculation of renting versus owning that favors renting more than it has in 40 years. But yeah, it's you're probably guessing a little bit, but you're probably right. It probably does take some sort of economic slowdown or for rates to at least for mortgages to come closer to what you used to have been able to get. Otherwise, the calculus of moving and giving up a really attractive mortgage, it just doesn't make sense. And I think until that happens, you don't have a lot of supply in the market.
So that's going to tend to keep inflation persist. I mean, the Fed's going to have more work to do.
Yeah, it's getting this last leg down is going to be tricky, I think.
I think there's, it's going to be interesting how this plays out, but, it could very well be as there's a lot of multifamily units that have come on the market. And as those rents come down, there will be some people who realize, hey, I just sell my house and move into a very nice apartment, particularly if you're a baby boomer, cash out, and then pay a lot less in housing costs through, rents. And, you might add to the supply that way. Housing has become more expensive because you can't deduct a lot of the expenses you could have in the past with, real estate taxes and things like that. So, you may see, supply coming on the market that way. Okay, well, I think in the pages, that last page, I think we talked about on page, let's see, I did finally, I apologize, I was on a different version of the report, not the one that I forwarded to Kelly yesterday, but on page 12, we talked about this last time, where the political parties, there's not a very good correlation between the party in power and the performance of the market during those periods. Hopefully, that kind of nonpartisan market behavior will continue. Why don't we go on to the portfolio itself, and you'll see the page, I think it's page 14, I think, the asset allocation page. And you can see the portfolio is now, as of the end of March, up to about 13.7 million. And most of the allocations are pretty close in line. Equities are slightly above the 65% target. And we're pretty close to, target allocations. The next page is the fixed income, and you can see it's a fairly high quality portfolio. The average bond in the portfolio is an A+. That's a very good high investment grade rating. We don't have low credit rated bonds. The idea is that if and when the stock market takes a big tumble, you want the bonds to perform well and not be subject to possible credit issues or defaults or something like that. And the average yield on the portfolio is over 5%. That's pretty encouraging. Ed sent me an article yesterday about a lot of big pension funds and endowments and foundations are shifting money from stocks into other investments, including on average, a little bit more into bonds. Some of that is a rebalancing because we've had such a very strong period over last year and then in the first quarter that the stocks are overweighted in a lot of portfolios, and it's a good time to move into these higher yielding bonds. But generally, it's providing some good competition for stocks, which are not, real cheap. The stock market is somewhat high on traditional valuation measures like price earnings ratios. And so you can get, as you can see here with Manistee, over 5% on bonds.
So Woody, with the asset allocation, your bonds right now are a little bit underweighted, like you said, probably because stocks have run up. But do you see doing something similar to what that article said, where you're going to maybe overweight bonds here shortly to kind of lock in some of those higher yields?
Well, the interesting thing is that you get a higher yield on money markets, or as high of a yield than most bonds.
Right.
The high yield, the yields on bonds are attractive to the very short end, like money markets, 1, 2, and 3 year. The further you go out, the lower the yields go. They drop down under the bond as you go out beyond a few years. So staying kind of short, some with money market funds, it's kind of a good place to go. Plus, as rates keep edging upward, it makes the value of the existing bonds go down. And that's the kind of the math behind bonds. Rates go up, the value of the old bonds goes down. And so I think Troy's view is let's see how this plays out. As rates edge up, more of that will be committed to longer term maturities. But right now, we're happy having a little bit more in the very short end, including money market funds.
And we muted Brian because we were getting some distortion. So Brian, raise your hand if you want to say anything.
Sorry about that.
All right.
So, and then the page 16 is how we're diversified with stocks. And, you know, I think we've talked about it before that we take a bit more of a defensive posture with stocks because our goal is to outperform during declining periods in the stock market. So some of these areas that tend to be a little riskier, such as information technology at the top, we're underweight there because that tends to be a more volatile sector, where areas like healthcare or utilities, we're overweight relative to the Standard & Poor's 500. You can see, for example, at the top, information technology, we're 20.6%, and the market is 29.6. Healthcare, we're 13.6, and the Standard & Poor's is 12.4. So, you know, this more defensive type posture has also kind of affected our performance, which we'll look at in a moment, because we haven't been in the hot areas of the market. The next page is Brian, you want to maybe go over the cash flow page 17?
Sure. Yeah, the cash flow and additions and distributions runs over the next 2 pages actually, but just have the fiscal year on the left side, ending balance. So if you actually flip to the next page, that at the end of 23, we were right at 13 million, and you can see the royalties for the year there. Over the life of the fund, it's the royalties have totaled over 1.1 million, and the distributions for the capital budget, over 6 million. And then we've had some one-time distributions. So in total, the distributions total about 6.5. So as we saw, the portfolio today is up to 13.7 million. Started with 6.7 and have distributed 6.5, and we're still growing to 13.7.
Any questions so far? Well, the page 19 is the performance, and we're happy with the long-term performance. The last 10 years, we're averaging 7.5% gross, 7% net. And we've had a soft relative performance relative to the Manistee blend for the last year. Some of the stocks, for example, like John Deere, Nike, United Health, Zoetis, which is the animal health company, those have underperformed. And then one stock, NVIDIA, that we don't own, although we'll be purchasing that very shortly, that's been a very, very top performer. Some of you may have seen that in the news. NVIDIA is an alternative, artificial intelligence chip company. And by not owning that and some of our actually the names that I mentioned, Deere, Nike, United Health, Zoetis, those are among our most favorite stocks right now, but they just haven't had a good performance here in recent months. But we're very keen on it. So I think some of this is just, it's a hot market. And as I mentioned a moment ago, we tend to underperform a bit in hot markets. And that's just the cycle of the market. So I think you can see all the numbers below. The equities, our stocks are over the trailing 1 year period are up 23.6, and the S&P 500 is up 29.9. So that speaks to it's been a terrific stock market.
I mean, Woody, wouldn't any portfolio have trailed the S&P 500 over the last 18 months unless you own those 7 stocks that comprised, what, 85% of the returns or something in the S&P 500, some ridiculously disproportionate number?
Yep, absolutely. You know, they refer to it as the Magnificent Seven, and it's, you know, about almost a third of the stock market. And if you don't own those, you're going to be behind. And I think, you know, what we're seeing with Manistee is part of that.
I mean, because you guys own Alphabet and Meta, right? Do you own any Apple or how many of those stocks do you own in the portfolio?
Well, we own most of them. Brian, you want to expand on that?
Yeah, so we own Meta, which is this parent company of Facebook. We own Alphabet, parent company of Google and YouTube. Amazon, we own. Microsoft, we own. And Apple, we own. So the 2 that we did not own were Tesla, which has actually helped a lot this year. It hurt significantly last year. Tesla's had a terrible year so far. And then the other one that has hurt us significantly last year and for the first part of this year is NVIDIA, which Woody mentioned, but that's actually pulled back significantly in the last few weeks, and we're kind of finally got comfortable with the valuation. The earnings have accelerated there so much that even though the stock's done really well, the value of that company has come down significantly over the last couple of years, and we think it's a very dynamic company, and we're looking to add that. But yeah, your point's very well taken. If you weren't heavily weighted towards those 7 stocks, especially last year, you likely like the market.
So is the Fed cutting rates in the next 12 months, or are they going to hold steady?
I defer to Brian on that.
Chicken.
Yeah, well, we'll have 2 more CPI readings before they meet again in June. So we'll have a couple more data points. The market's pricing in a very small likelihood that they would decrease in June. Only pricing in 1 cut in September at this point. So we like we said in the beginning, we need to see improvement on inflation before I think the Fed feels comfortable cutting rates. And if the economy still is running along pretty well, you know, those are their 2 mandates: is full employment and inflation, and both of those are not giving them any green light to go ahead with cuts right now. But a lot can happen in 8 months, though. So.
That's about all we had prepared. Always happy to answer any questions.
Ready?
Not seeing any questions, guys.
Go play golf.
All right.
Ed, I guess, when do you expect the distribution, the capital fund distribution, capital budget?
We're good for this year, so probably sometime after July 1st.
Okay, maybe August, September?
Probably, yeah. I'll get with you on that and kind of hone in on a date so you guys can plan your cash flows.
Okay, good.
Great.
Okay. Thanks, everybody.
Thanks,
Thank
have
you.
a great
Thank
day.
you.
Okay, I know.
Thank you.
Okay, anybody else have anything? No? We have no public comments, so motion to adjourn.
Make that motion.
I'll support it.
Can you guys do this on your mic and see if you're